Hey friends, I'm back with another quick take on chapters 3 to 4 of A Random Walk Down Wall Street. My last quick take wasn't so quick. This one will be fast, I promise. Hope you're enjoying the book as we're making our way through. Chapters 1 through 4 are really very fascinating because Burton Malkiel gives us a walk through history, and we get to see how often history repeats itself, and he gives us a tour of the biggest stock market bubbles in history. So just a quick tour through those. We had the tulip bulb craze in the 1600s. We had the South Sea bubble in the 1700s. We had the Wall Street boom of early business and the early Wall Street in the 1920s leading into the Great Depression. Then we get some more. There have been so many since then. In the soaring 60s, it was the electronics boom. Anything electronics, anything space age was the rage, right? That ended badly. We had the synergy boom in the late 60s, the conglomerate boom. Conglomerates were favored by Wall Street. Take two companies, put them together, they've got better earnings per share. That ended badly. The Nifty 50. Wall Street got its act together, so we're only going to invest in blue chips, the really big companies like IBM, McDonald's, the stable blue chip companies. Well, that ended badly as well. Those companies went from $80, $90 per share down to $10 to $20 per share. So huge declines there. We had the roaring 80s. New issues were back. It's the South Sea bubble all over again. New companies were all the rage. And promising just crazy things like personal robots and not having any profits or anything to justify their valuations. That ended with the October 1987 crash. We had the Japanese yen bubble, the land and stock bubble in Japan, speculation on Japan's land values. The land value of Japan became more valuable than all the land in the entire United States. That ended badly. We had the internet bubble. Many of you may or may not remember the internet bubble in 1997 to 2000. The dot-com bubble, anything .com, pets.com, anything adding .com to its name. So a huge investor interest. That ended badly. The NASDAQ fell by 80%. Then we had the U.S. housing bubble. We're getting close to modern times. The U.S. housing bubble, 2003 to 2008. Housing prices can never go down, right? Well, of course, we all know how that ended with the Great Recession in 2008, the Great Financial Crisis, almost destroyed the entire world economy. It doesn't stop there. We had the meme stock bubble. Now, this was not as mainstream, but it was a thing. The meme stock bubble in 2020 to 2021, social media fueled speculation, retail investors investing in GameStop and AMC and different things like that. You may remember that. But that, of course, ended badly as well. Most of them dropped down, way back down to their original values, and some even lower. Well, what's the next craze? AI? I'm fascinated by how there are some common themes throughout all of these bubbles. One of the most common themes is that many of these bubbles originate around some kind of new technology, some kind of promise to transform the world. And the story sounds great, but I want to read you a little thing from A Random Walk Down Wall Street. I want to read you one quote. He says, "The key to investing is not how much an industry will affect society or even how much it will grow, but rather its ability to make and sustain profits." That's the key, friends, right? You might sure, androbots in the 1980s sounded like a great idea. It's going to transform the world, it's going to transform history, but it didn't translate into real profits. And it's interesting also just how similar it happens to be time and time again. In fact, you'll love this one. In the 2000s, there was a company offering an alternative currency called flues. It's part of the dot-com bubble. Flues. Hey, does that sound familiar? Alternative currencies? Crypto, Bitcoin. In fact, the Mississippi Company back in the 1700s was the first to mess around with alternative currencies in the form of paper currency. So we have seen these things time and time and time again, right? And they're constantly driven by new technology, new crazes, new things are happening, the internet, the space age, the electronics boom, right? There's always something new that's driving these things. What's next? Is it AI? Is AI the next bubble? Is AI speculation going to really do what people think it's going to do? Maybe, maybe not. We have yet to see. Well, there's some big lessons that we can learn. Number one, no institution or person consistently knows more than the market. The professionals on Wall Street do not know where prices are going. They don't know. They make predictions. Their predictions are wild guesses. A monkey throwing darts at a board would do better. Most of their predictions are always wrong. 99%. 99% of mutual funds fail to beat the market because no one knows more than the market. You see a guy on TV saying that he can pick stocks, he can teach you how to be a day trader. Well, why isn't he on Wall Street managing the biggest hedge fund or working for Goldman Sachs? Right? Because if the professionals can't beat the market, who have studied and done this for years and years and years, how can anyone else? Lesson number two, all excessively exuberant markets succumb to the laws of gravity. If you see a stock, you see something doing tremendously well and everybody's jumping on the bandwagon and your friends and your neighbors and your cousins and your uncles are telling you, you've got to buy this stock, watch out, be cautious. Lesson three, gambling does not equal investing. It's fine to gamble. There's nothing wrong with gambling on speculative investments, but it does not equal investing. Most day traders lose money. I would venture to say 99% of day traders lose money. You see a guy on a billboard offering you a day trading course, promising that you're going to be rich, you're going to be able to have financial freedom, just take my course for $99.99. Run. It's not hard to make generous investment returns in the market through a simple, broad-based portfolio of stocks, my friend. You don't have to be a day trader to make a lot of money in the market. Lesson four, speculative bubbles will continue to occur, but they lead most of their participants to financial ruin. Just be aware of that. Most people who participate in these speculative run-ups end up worse off. They end up losing money. And finally, avoiding speculative investing mistakes is perhaps the most important factor to preserving capital and actually growing your wealth. So that's my take on chapters 3 to 4, and hope you're enjoying the book. We'll see what comes next.